Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and the Indian markets are not showing any signs of a let-up. If anything, FIs have continued to do the cash market buying, and the result season thus far is not turning out to be the one that is underperformed expectations. So can the Indian outperformance continue, or will India lag peers, as peers which have been beaten down all the way through 2022 try and make a bit of a comeback either in the last quarter of the current calendar year or in 2023? Abhay Agarwal of Serica joins in with his thoughts on the question that I've just posed and some ancillary thoughts around it. Abhay, good having you. Thanks for joining in. Hope all is well.
Thank you very much, Neeraj. Great to be on your show again, and yeah, looking forward to the conversation.
Yeah, likewise. So Abhay, that's my starting point actually. India has been a rank outperformer. There are people who believe that as Dr. Kospi and some of the other emerging markets which have hitherto underperformed start or make an attempt to outperform if the dollar indeed peaks out and if the Fed rate hike narrative tends to come off after the policy meet this time around, then India could be a good performer, but an underperformer relative to the other markets. What are your thoughts on this?
Well, yes, that is possible. But Neeraj, I would like to look back over the last 10 years for what has happened for emerging markets versus developed markets. Emerging markets as a basket has underperformed developed markets, which is largely US, by 9% per annum. So we have seen stark underperformance by emerging markets, of which India is one part. And it's only in the recent past, or maybe this post-COVID, that we are seeing Indian markets holding up, and the outperformance is not that Indian markets have gone on to hit new highs, but on a relative basis, they haven't fallen as much as some of the developed markets have, especially the US. You look at NASDAQ correction of 30%, and India has been unscathed. Now, when capital comes back, and it is, as you rightly said, look, people are looking at triggers. Their 2-year bond yield, falls to 4% or below, that will be a big trigger. Everybody is watching for, the inversion of the yield curve to straighten out, smoothen out. Now, if that happens, and we are seeing early signs of capital coming in, now it's a moot point whether that capital will go more into markets that haven't performed, like Kospi and Hang Seng especially, which has been beaten down, Chinese stocks. It's a moot point, but I think India will continue to get its flows. I think the flows that we are seeing are pretty robust. They are from long-term investors. They're not from hedge funds. These are ETF flows. We are seeing a lot of people allocate capital to India for the first time. Very deep-pocketed investors, especially from the US, who are coming to India for the first time, and these guys are not going to go back very quickly. So I think all in all, I would say that yes, it is probable that India underperforms the emerging market basket, but it is also possible that as capital comes in, everybody benefits. So at this point of time, I don't think there is any possibility of us seeing a sharp correction in Indian stocks because the capital goes to other countries.
Okay, so correction is ruled out, even if an outperformance versus peers might be difficult as well, but a correction is ruled out. Now, it's an interesting point you make, Ben. I want to probe that. First-time long-only investors. Now, my question is, the whole of last decade, FIs which came into India came in for the Indian consumer. It was not for the amazing manufacturing capabilities or infrastructure, vagera, vagera. Is the case this time around slightly different in that because infrastructure is now seeing serious focus, because manufacturing under PLI, under defense, under various other factors is seeing serious push from the government, are foreigners biting into the other side of the India story, which is non-consumption, or is it still consumption driven?
Well, I mean, that's a great point that you have brought up, and we discussed this also, that look, where is foreign capital going to go? Which are the sectors that are going to benefit from this foreign capital? And what we are seeing is that there is a large percentage of investors who are looking at India becoming an export hub of manufactured products also. It was always known for its services prowess. We have world-beating companies in that space. But for the first time, we are seeing this belief emerge that with government support through PLI schemes, and already there are signs of success. I mean, last month we exported $1 billion worth of iPhones, Apple products. And so if Apple is manufacturing in India, Samsung is manufacturing in India, there are companies in the EMS space like Dixon who are scaling up very rapidly. And India can become a manufacturing hub not only for electronics, for chemicals, for bulk drugs, for auto components, basic electronics, 3, 4, 5G equipment. Again, government has said that all the 5G equipment procurement should be done in India. There should be no import. So that will give another boost to the manufacturers. So I think a lot of things that are happening where the government is also very focused, and it is translating into action for the first time, where we are seeing large capacities come up, which drive the efficiencies of cost, making Indian producers competitive at a global scale for the first time. So I think it's a great play that will play out over next 5-10 years, and we expect to see a lot of foreign capital go into that space now.
Now, but you are of the belief that for the near term, domestic consumption is starting to pick up as well. So therefore, my question to you would be, where would your portfolios be tilted? I read from your newsletter that you're probably sitting on 5-6% of cash, 95, 96, 94% is deployed.
Yeah.
Is the bent towards consuming themes, or is the bent towards the manufacturing theme, or is it kind of 50-50?
I would say it's 50-50. We don't want to rule out any opportunity that helps us, create value and benefit from, shareholder returns. So I think the large themes that are playing out that we see are, this rapid pickup in consumption demand from tier 2, tier 3, tier 4 cities. And this has happened both through digital channels. We have seen that digitally it's happened much faster because, so companies like CAM, CDSL, Angel One, they regularly tell us that, look, most of our accounts, 70% of our new account opening activity is from smaller cities. That is the easier part, because that is the digital channel, you connect and, you see an OTT apps. The more difficult is the physical distribution product. There is demand, but frankly, India Inc. never made an effort to go to these smaller cities to set up their own distribution network, to set up their own. Very few companies did. And I think now there is a great opportunities for companies to go and set up their own showrooms, own distribution channels, commit to that for next 5-6 years and benefit from the explosion of demand that is taking place for basic stuff like home improvement. We're seeing demand for bathroom fittings, for instance, for cars, automobiles, two-wheelers, electric vehicles. The electric EV two-wheeler sales is maximum in these smaller cities. They don't have to line up for petrol pumps. They can just charge it at home. So I think there is a big shift in consumption demand coming in from these smaller cities, and I think that will be a big theme going forward. So you marry that with digital suppliers of products. You marry that with manufacturing theme in India. I think that's a great play that emerges, and I think that is what is also keeping the foreign investors excited about India.
That's actually a half an hour conversation separately, Abhay. We'll love to, but yeah, this is an interesting point that for a lot of smaller cities, the charging points for EVs would be so much easier.
Yes.
And it's something that needs to be probed into. Okay, we'll do that at some other time. For now, let me try and stick to things that I thought I'll ask you. In your newsletter, you said that your view on the Indian markets is more sanguine than most market commentators, and the view is based, and I read out, the view is based on the on-ground reality that we see as we engage with various distributors and retailers of our portfolio companies. Now, Abhay, take some time and tell us some of the key findings that have come to you in the month of October as you would have done this exercise.
So I would go beyond October also. I would
okay, sure.
August, pre-festive season. That is when we were talking to two-wheeler distributors, and two-wheeler distributors have had a horrid time over last 5 years. You have seen one-way drop in volumes. Started before COVID, didn't stop after COVID. For the first time, we heard the auto distributors, the two-wheeler distributors tell us that, look, we are telling the OEMs that we have very, very small inventory compared to what we are seeing in terms of inquiries. Because they first see inquiries. If inquiries are good, then they get the confidence that there will be sales and there will be deliveries. And people typically don't want to wait too long for deliveries. You go to a Hero Moto guy and you say, okay, how long will it take me to get a motorcycle? If he says 3 months, you go to Bajaj. Bajaj says 2 months. Then TVS says 1 month. You would probably go with, because you want it in the festive season. So all the distributors were telling us that we are telling the OEMs to boost inventory. Pre-COVID, the inventory levels used to be 60 days, 65 days. And recently they had fallen to 20, 25 days. So there was a worry that, look, the demand inquiries are there. It will translate to demand. How will we supply? So we saw that coming up again and again, that there is almost a panic before festive season, that is there adequate inventory in the system. Then what we started seeing also is a demand for home improvement post-COVID. People said, look, I'm redoing my house. I haven't done anything for last 3-4 years. And I saw this, I can't afford to buy a Jaguar fitting, which is made of stainless steel, and it is a 2,000 rupee product. But I don't want a plastic cheap fitting also that cracks, every year. So I'm happy to pay for a branded bathroom fitting, so what I will pay normally, 17 rupees for a simple tap, PVC tap. I'm happy to pay 40 rupees, 50 rupees, as long as you can tell me that it will look good and it will not break. So there is an upgradation of that demand. It is not at the city demand level. So I don't think Jaguar would find a market in these places, but there are companies like Astral, Apollo Pipes, who make better quality bathroom fittings of PVC. They will find a market. So I think if I triangulate these kind of, not anecdotal, but factual experiences, then it is, we are seeing that there is demand, and also it is backed by income. If you look at it, government has improved the MSP by double in last 3 years. So it's not that farmers are, hand to mouth. They're making good money, and the Manrega is giving jobs, employment. We have some of our investors who are in real estate business, and they constantly tell us that 20% of the labor force hasn't come back from the village post-COVID. And what they used to pay a worker 600 rupees pre-COVID, it has gone up to 1,200 rupees, now. So that's the daily wage rate in Mumbai now for a laborer, for a simple unskilled laborer. So what is clearly happening is that people are not moving to urban towns as they used to earlier, because those opportunities are presenting themselves in wherever they are. So I think that's a big shift. Yeah.
But that's interesting, because just conversely, when you hear the commentaries from Dabur or the results from a Dabur or a HUL, etc., rural hasn't fired in Q2. If anything, rural has suffered. So where is this dichotomy between what these companies are saying versus what your channel checks are suggesting, Abhay?
So I think, again, we did check this, and we said, look, Sanjeev Mehta of Lever is saying that rural is still not firing, and some of the other guys. But really, what is happening there, Neeraj, is that people have more options. So, and they are going beyond the traditional Lever, ITC, Dabur kind of products. There are local products. And they're not, again, I would not use the word down trading. They're not trying to save cost, though these guys did raise prices in last 3 months, and they had to protect margins. But I think that led to a volume share loss for them in rural areas. And now they're fixing it by dropping prices. If you heard, if you saw recently last week, Lever, everybody announced that they're dropping prices. And that's to fight back for the volumes, because these rural areas have options now. There are other companies which are meeting the demand for soap, detergent. There are very good local products that haven't made it to national level, but they are very strong local products for snacks, for cold drinks. So I think it's just a volume shift from large guys to smaller guys there.
Interesting. Would you be negative FMCG then? I'm just wondering, the listed FMCG players.
So I think FMCG will have to reinvent itself a little bit. I think just go beyond cute things like smaller sachets or mass advertising. I think the valuations may also shift downwards in line with what these companies trade at globally, which they're seen as consumer staples, not really as premium companies. And I think just as it happened in China, competition will emerge from local brands, because they are also learning the skills. They are also learning how to play this game.
Yeah.
So I think there is that risk of competitive.
Abhay, what are the changes that you made to your portfolio? Maybe you haven't made large scale changes, but there could be some small pivots here and there. Yeah. Can you tell us and the rationale thereof why you would have done that?
Yeah, sure. So as you rightly said, we haven't made any large scale changes, but there are We had earlier this year some companies that were on that had internet-based businesses like India Mart. We had Info Edge, and Info Edge especially we had for like a very long period of time, so almost since listing, you can say. And it was a tough call to remove them from the portfolio. But the reason we did that is because we saw a marked slowdown in their core assets. I think if you look at Info Edge, the only profit-making business is Naukri, and Naukri is supporting the entire valuation. Whereas other companies like Zomato and Policy Bazaar, though they are subsidiaries or not even subsidiaries, just portfolio investments, they continue to bleed. And Jeevan Sathi, 99 acres, same issue. So while the management is very bullish on turning things around, we didn't want to stay in that high valuation zone because we're seeing remarkable correction in valuation of similar companies across the board. You have Alibaba that has fallen 80%, Tencent, Baidu. In the US, you have Meta, you have company like Amazon. I won't use the word trashed, but it almost is in terms of valuation. So you have companies that are profitable, trading at 15 times, 20 times, all those value investing space. So when we saw that, we realized that look, in India market, it's just amazing. I don't know why it trades so high, but maybe a good time to exit those and get into companies that are building rural distribution. So we got into autos, two-wheelers, TVS, Bajaj Auto. We added Apollo Pipes, which is a sister concern of a company, APL Apollo. We have had in the portfolio for 7-8 years now, almost a 10-bagger. We have added a small bank for the first time. We never had a small bank, but we're still adding it. So, and the focus there is new management, came from a very large bank background. A new CEO turned around things around over the last 2 years. So I think there are opportunity spaces, stock specific, and India has always been like that. It is, if you look at it at a market level, Nifty level, it always disappoints bulls and bears both at the same time. But on the stock basis, specific stocks, especially in small cap, mid cap, if you can build a conviction, I think that is where the big rewards come.
Interesting answer. Thanks, Abhay, for that. A couple of follow-ups here, if you will.
Sure.
One is on mid-sized banks. Now, hitherto India has always assigned a premium to large banks. For the longest time, there was promise in a federal bank. Somehow the stock prices never moved. IDFC First Bank, Vivedyanathan came in, a lot of promise again, the stock prices didn't move. 2022 has been a bit of a different year in that sense. And now I hear these managements, when they talk to us, talk about the possibilities of cleaner 20 to 25% CAGR for the next few years on much better asset quality, because frankly, the number of stressed sectors out there is going down by leaps and bounds, so to say. Is this the right time to log into mid-size or small-size banks with better valuations versus the larger banks, you think?
Oh, yes, I think so. And, I have worked in banks and I know quite comfortably how banks work. So I think there is a tremendous opportunity to look at some of these small and mid-sized banks, but not all of them. And I will say, I'll tell you the difference. What we are looking at are small banks that have improved corporate asset side, corporate lending asset quality. See, retail is a tough business. You can't really compete against the big guys, ICICIs and HDFC banks of the world, access in retail banking, because really a customer, even if you have him as a customer, would always tilt towards the bigger banks because of better digital experience and better product experience. So it is the corporate book that defines your success. So if you have the management that has the ability to get corporate bank accounts and better quality corporate bank accounts and shows lesser NPAs there and a stable NIM, stable asset quality, I think that those banks, if you're trading at one-time book or below one-time book, will definitely re-rate. So I think there is an opportunity, but investors will have to be very careful what they're getting into also.
Interesting. Thanks. Abhay, your newsletter also suggested that you've gotten into a large cap IT name. Now, my question is only this, that, if I leave out InfiTCS, and I'm not asking you for the name, by the way, but I'm just saying, if I leave out InfiTCS, the others are available at really good valuations. But could there be a period of a slightly prolonged sideways performance by these companies as the Western world grapples with slowdown issues, And even if they don't cut budgets, the sentiment of the possibility that they might cut budgets might keep these enthusiasm in these stocks subdued. Plus, the FI selling continues unabated on the tech side. So, why the timing is the question?
So you're right. I mean, it is possible that the valuation, roughly these stocks trade at anything from 23 to 30 times P multiple. So it is possible that they can go sideways. But again, I think in the IT space, Indian IT space, there is divergence taking place between companies that are doing really well and companies that are struggling. And I think we are seeing this for the first time, even in the top names. So you have TCS, Infosys, LTI, Mindtree that came out with very good set of numbers, very positive commentary. And then you have some certain others like Wipro who have struggled to show growth and have underperformed compared to estimate. Now there is, and we are not seeing. I mean, I keep hearing this slowdown of demand or potential slowdown of demand, but when we talk to the management, we don't see that. In fact, the number of deals that are put out to bid, through the RFP every month, every quarter is pretty much same if it hasn't gone up. So what has happened is that the customers in these countries are also looking to cut costs, and one way to cut cost is to offshore, to outsource. And I think I'm not expecting any margin improvement. I think the margins are what they are, but even keeping the same margins and with lower attrition rates, I'm very positive that these companies can show better growth in next 2-3 years than what analysts are expecting, because the Western world needs to import deflation. It needs to cut costs. It needs that. So, and it will happen only through these companies. So, and if you look at TCS is in the category where IBM, Accenture, Capgemini, maybe there are 4 or 5 global companies now which are called to bid for $1 billion deals. So, you're already in that great space. Just need to be there and deliver appropriately. And same with Infosys and some of these other companies are getting into that space. So I don't think as a sector we will do outstandingly well, but some of these companies will continue to grow faster than expectations.
What's your view on the biggest buzzword on the street these days? Defense. Almost everybody seems to be piling on, but the commentary is red hot. I mean, Prime Minister Modi yesterday, I think, has mentioned targets of 25 billion by 2025, UP corridor, TN corridor, all aiding. What are your thoughts here?
No, I think it's a massive space, and it has always been. And unfortunately, we were importing a lot for a very long period of time. So it's nice to see foreign companies coming in, going with this tie-up with Tata's and, some of Bharat Forge and Mahindra and L&T, large companies getting into that space. Plus, we have PSUs who have done a remarkable job. I think Bharat Electronics, HAL, are remarkable companies that have done very well in that space. My only worry, Neeraj, is that the procurement side of this defense has not changed, and that we know historically has been rife with opaqueness and lack of transparency and issues that keep coming up. So I would, before jumping in, I would like to wait to see how the government is changing its procurement cycle. Is it going to become more transparent? Is it really the most competitive company with the best product win, or will there be some other issues? But I think it is definitely a space of the future. It will grow, and not only that, I think even the space-based defense programs will expand. So I think there are opportunities for investors. They just need to be a little careful that it's not the space where always the best company wins.
You haven't taken the bite as yet, I presume. You're watching but haven't taken the bite.
We are looking very actively. We are looking at companies, but we want to get the confidence that these companies don't go into a feast to famine kind of model where 1 year they have great purchase from the government and the next year they have nothing because somebody else gets the contract. So we need to see that part play out, that once you're selling continuously and you're a L1 supplier, and that L1 stays for 5-10 years.
Interesting. Okay. My final question, Abhay, is on a theme which a lot of Diwali conversations brought out as a dark horse, which is cement.
Yeah.
Now I hear very contrasting views on this pocket, with some people believing that these are not the valuations to enter, and some people believing that if you discount the future earnings, then this is a space which is ripe for accumulation stroke large scale buying. What are your thoughts?
No, we have looked, Neeraj, at this space, and we continue to look. We have never been able to pull the trigger and buy a cement company, but we keep looking because, of course, in a country like India with great infrastructure needs, capex picking up, government and private, there is going to be demand for cement. The problem is that a company cannot override the industry structure. So you're limited to that, and the problem here is that there is tremendous capacity expansion that is still going on, and you have very large players like Adani come in with bottomless cash with them, availability of funding. So we are not able to assess that will this capacity expansion stop at some point and players will say, okay, enough now, let me focus on increasing prices. And so far, whatever capacity addition that has taken place has made money only because of government capex. The private capex has still struggled. So we want to see these two things kind of come together where people say, okay, enough, I'm not adding capacity anymore as an industry. And secondly, that the private capex has now picked up and I'm selling a lot to private players and not only government. So I think when these two things come together, then I think cement would become a very interesting bet.
Not as of now. Great. Abhay, lovely talking to you as always. Thanks so much for all of that intelligence and your time, and look forward to having you more often on the forum.
No, thank you, Neeraj. It's been my pleasure always to come on your show and talk to you. Thank you so much for having me.
Much appreciated. And viewers, thanks for tuning into this edition of The Talking Point.